So next, I'd like to introduce Mariah Lichtenstern. She's the founding partner of Diversity Ventures and a managing director at the Founder Institute. Mariah's project focuses on enabling tech funding equity, providing new opportunities for disadvantaged founders to find new funding. We're very excited to release her products today, and she's here to tell you all about them. So over to you, Mariah.
Thanks so much, Betsy, and all who are watching today. I'm super excited to share this project with you. So the funding gap is a term that's used to describe the lack of equitable startup funding for underrepresented founders, specifically Black, Latinx, or female. 13% of the US population is Black and almost 17% is Latinx, yet less than 3% of venture-backed founders are from those ethnic groups. A full 82% of venture-backed founding teams are all male. So the policy problem I set out to solve is how might we close the early stage funding gap for underrepresented tech startup founders? Generally, we've heard that Silicon Valley, the epicenter of technology startups, is a meritocracy, and that a lack of diversity is a pipeline problem, but this is just not true. In deconstructing the pipeline myth and the case for more diverse fund managers, Kauffman Fellows found that neither education nor the number of underrepresented founders in the pipeline could explain how underfunded Black, Latinx, and female founders are. Furthermore, they found that ethnically diverse founding teams and leadership teams have higher realized returns on positive exits. And an often cited McKinsey analysis shows that companies in the top quartile of gender and ethnic diversity are more likely to outperform their counterparts. What's especially frustrating is that this persistent lack of funding to these underrepresented groups has a negative impact on our entire economy. The Center for Global Policy Solutions found that discriminatory finance practices that favor white male founders cost the U.S. no less than 9 million jobs and $300 billion in annual national income. So how do we get to the root of this? Venture capitalists bear the brunt of media criticism for demonstrated inequities in tech funding, and it's understandable because the data is clear that bias exists. In one study, researchers found that VCs are more inclined to fund pitches when the presenter is male. Participants rated women as less persuasive, logical, and fact-based, even when they made identical pitches to their male counterparts. And this was also true of both male and female investors, which can be partially explained by the pressure that underrepresented investors feel to conform to the status quo so as not to rock the boat and be seen as a social justice warrior. Then there's homophily, a phenomenon in which humans network, socialize, co-invest, and partner with those most similar to them. The fact is, for a number of reasons, venture capitalists are overwhelmingly white and male. And a LinkedIn survey revealed that only 2% considered diversity a priority, which is why venture-backed founders are more of a meritocracy, with over a quarter of startup funding concentrated in Silicon Valley and more than half of VCs having a portfolio construction that's 25 to 50% Ivy League founders. Not only do venture capitalists tend to network and invest in those most like them, they also exclude those who aren't. And this is reflected in the underrepresentation of Black, Latinx, and female investors too in the hiring process. And while it's true that these issues are problematic, the funding gap starts much earlier than venture capital. Of the $500 billion a year that goes to startups, 60% is founders-owned resources, known as bootstrapping. 38% comes from the friends and family round. Less than 2% of startup capital comes from angel or VC funding. And herein lies the problem. The Securities and Exchange Commission, SEC, regulates how founders raise capital, including whom they raise from, how, and how much they can raise. All of the regulations you see here have one rule that's a common thread. That rule is Rule 501, defined under Regulation D. This rule defines what constitutes an accredited investor. To be considered accredited, investors must meet established thresholds for income and or net worth. And through this definition, both founders and funders face separate and unequal access to startup offerings and investment opportunities. Less than 15% of Americans meet the criteria for accredited investors. And of that, less than 5% are Black or Latinx, 22% are female. Why? Because mostly the wealth gap. The average white household has 7 times the wealth of the average Black household and 5 times the average Latinx household. And when we look at the median wealth, the gap is even wider. So the mission of the SEC is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. But barring investors based on income and net worth defies those goals. To understand the significance of this role, one has to look beneath the surface to the history of the SEC and other federal agencies formed during the Great Depression, also a time of racial unrest, and when Black Wall Streets across the nation were being destroyed by race riots. While the Federal Housing Administration and Homeowners Loan Corporation explicitly excluded Black Americans from creating wealth in real estate through a process known as redlining, the SEC was more covert, using the accredited investor definition as a dog whistle term to veil economic exclusion. So while income inequality makes it hard for most founders to raise capital, the wealth gap makes it especially hard for underrepresented founders to bootstrap and to raise capital from their own communities, even those with financial resources and the risk tolerance to invest. The SEC calls this rule a form of investor protection, but it only applies to private markets, not to public markets. All investments entail risk. The liquidity of public markets also contributes to its volatility. People buy and sell according to various strategies, advice, and even headlines. Non-accredited investors lose life savings on consumer apps. And let us not forget that the most devastating losses to our economy have been in the public markets. That is, after all, what the SEC was formed to guard against. In the private market, most startups fail or deliver a modest return, but the reason why limited partners entrust venture capitalists to deploy tens of billions of dollars each year is because it only takes one major win to make up for a multitude of losses and return a multiple on a fund. Investors buy startups for pennies per share at the earliest rounds. Imagine if, instead of being limited to crowdfunding offerings, Americans were free to invest and to diversify their risk by investing in venture capital funds. These opportunities are extremely limited under the current rules. I don't know if anybody else has pulled money in a church building fund or other philanthropic projects, but how is it that we have financial autonomy on spending, but not investing? Even if we were to give the SEC the benefit of the doubt and assume that the accredited investor rule is truly intended to protect investors from loss, is paternalism the best policy? Restricting Americans from investment opportunities does not protect them from losing money elsewhere. It just ensures that they don't have equal access to some of the most lucrative investment opportunities. With these facts in mind, this project proposes 2 solutions to closing the funding gap. The SEC has published a concept release requesting comments on proposed changes to the accredited investor definition. You'll find a policy brief on the topic on the Aspen Tech Policy Hub website. I'm also publishing a petition to be delivered by email to the SEC along with a public comment. The second solution is the Opportunity Pledge, Accelerating Equity and Startup Opportunities, which aims to engage private equity investors to increase investments to underrepresented founders and fund managers 10x by 2025. This pledge includes a framework to facilitate greater access to diverse deal flow, empowers underrepresented fund managers to establish investment track records, and increases access to investor networks for underrepresented founders. These solutions are hosted on our techfundingequity.com website, where stakeholder engagement and continuing advocacy can take place. So the homepage contains quick links to each project. Viewers can read the policy brief and also sign the petition. They can enroll in the Opportunity Pledge, and there's quick links to infographics summarizing solutions and actions that stakeholders can take. Here you can see a dedicated page for the SEC rule and the actions that you can take for that solution. And the Opportunity Pledge page, it summarizes the purpose and framework with access to the pledge itself. And the ability to enroll. Once stakeholders enroll in the Opportunity Pledge, they'll be sent a link where they can download not only the white paper with the framework, but also their certificate of participation and other resources. And all stakeholders can subscribe to the newsletter for updates. We invite you to participate as we engage in partnerships and coalition building to close the tech funding gap. Please subscribe, follow us on social, and visit our website. And in closing, I'd like to acknowledge the incredible support that went into this project from the team at the Aspen Tech Policy Hub and Aspen Digital. I'd also like to send a special thanks to Dan Porterfield, who joined us for dinner in January and imparted how racism and inequality are two of the most important issues we must address in the world today. I also want to thank my project mentor, Chris Russell, startup advisor and investor Cheryl Beninga, Matthew Friedman of the Mekong Club, Frank Casey of Casey Moats, Jonathan Greachin and Adea Racy of the Founder Institute, Cameron Law of the Carlson Center for Entrepreneurship at CSUS, and many more who supported this project. Back to you, Betsy.
So much, Mariah. I think we can all understand how important it is to have a more diverse group of folks developing new products, and how difficult it is, especially in this current environment, for people to get funding. So we're really, really pleased to release these products today. I hope you'll take a look. If you see the chat, you can click on the products right now and take the pledge, sign the petition, and really use this as an opportunity to get involved on these important issues. So thanks again, Mariah. Your project suggests a really simple and elegant solution for combating startup redlining, a policy shift at the SEC that could lead to more equitable investment standards. So the questioner asks, could you tell us more about how the Opportunity Pledge builds on this policy step and how it would help ensure more representative investors and startups?
Thanks for the question. So I think one of the challenges that we see in the problem of tech funding equity is that there's an assumption that we can't walk and chew gum. For example, when you say diversity in Silicon Valley, the priority has been on gender diversity. And the assumption has been that we can't do things in parallel, but we can. So in addition to getting to the root of the problem, which starts before founders even get to the VC stage, we can work with the founders and the underrepresented fund managers that are already in the pipeline, but because of heuristics that have kept them out, they've not been able to progress equitably. So the Opportunity Pledge is designed to benefit both emerging managers and existing managers by not only having a pledge that that private equity investors, limited partners, and venture capitalists can commit to, but also a framework that guides them on carrying that out and provides a community of support, because this is not about naming and shaming and blaming. This is about, okay, we see that this is the time to change. It's long overdue. How do we work together to make sure that this happens and that we don't backslide like we've done so many times before into complacency?
Thank you. And another question for you from Adele Burns. Have you thought about the intersection of the early stage self-funding and friends and family rounds with the evolving conversation around reparations? Perhaps there is a policy movement at the state, federal levels around that kind of funding. What do you think?
You know what, that question, it kind of caught me off guard, but you know what it reminded me of, Betsy, was the project that that you opened the door for us to do on day one. And so my project was around a social equity fund, a social wealth fund for our nation. So something like a sovereign wealth fund, but a social wealth fund whereby our nation could invest, and we've seen trillions put into the pandemic response, but we could invest in a fund that that invests back into the startup community and the technologies that keep our nation secure, help to develop technologies that have things like, what other participants have presented in mind, cybersecurity, et cetera. And we could have the returns from that go back into the social wealth fund and help to fund reparations, a basic income, to where we're not always going into debt to fund things like our pandemic response. We have a reserve that is created through the wealth that we generate as citizens, and that we should all be invested in as stakeholders and shareholders in our country. So yes, I think the reparation discussion is long overdue. I think the question is, how do we do it? And we've really not committed enough discussion to that. But I do think that there is an intersection in tech and reparations. So I'm happy to explore that further.
What is your bumper sticker for this conversation? So if you had one sentence that you want people to understand and get across from what you've experienced here, what would be that bumper sticker?
Stop startup redlining.
We remind you to check out our website at aspentechpolicyhub.org to see all the amazing products that we've released today. Congratulations to the fellows, and thanks again on behalf of the entire Hub team. Have a great afternoon.